Welcome students and scholars. This is the final ASC 220 practice session, and now we are going to test whether the concepts can stand on their own feet. We will work through 8 multiple choice questions and 8 short answer questions. The purpose is not just to choose answers, it is to build exam confidence and professional explanation skill. By the end, you should be able to explain net income, comprehensive income, OCI, AOCI, reclassification, unusual items, and business interruption insurance clearly. Think of this as the accounting gym session, not painful but definitely useful. Here is the practice path. First, we will work through 8 MCQs. For each one, read the scenario, choose the best answer, and then review the explanation. After that, we move into 8 short answer prompts where your job is to explain the rule in clear accounting language. Keep 2 goals in mind throughout this video. Apply the ASC 220 rule precisely and explain why the rule works. That combination is what separates guessing from real exam readiness. For every multiple choice question, use 3 steps. First, read the fact pattern and identify the concept being tested. Second, evaluate all 4 options and remove the clearly wrong choices. Third, review the answer logic even if you selected the correct option. That review is where the scoring improvement happens. Sometimes the exam is not trying to trick you. Sometimes it is simply checking whether you read one important word carefully. Choose your answer with discipline, then compare your reasoning with the explanation. Question 1 asks, which entity is outside ASC 220 scope? The options are an entity with cash flow hedge OCI, an entity with foreign currency translation OCI, an entity with no OCI items, or an entity with available for sale debt securities. Think about the purpose of ASC 220. It governs comprehensive income presentation, so the key is to identify which entity has no other comprehensive income items to report beyond net income. The correct answer is C, entity with no OCI items. ASC 220 becomes meaningful when an entity has other comprehensive income items to present. Cash flow hedge, OCI, foreign currency translation adjustments, and unrealized gains or losses on available for sale debt securities are all classic OCI sources. If an entity has no OCI items, comprehensive income equals net income. So a separate comprehensive income structure generally adds no useful information. No OCI means there is no extra OCI suitcase to carry. Question 2 asks, comprehensive income excludes which item? The options are owner distributions, foreign currency translation gain, cash flow hedge gain, and pension OCI adjustment. This is a boundary question. Do not just ask whether the item changes equity because many items change equity. Ask whether the change comes from owners or from non-owner sources. That one distinction usually unlocks the answer. The correct answer is A, owner distributions. Comprehensive income captures changes in equity from non-owner sources. Dividends, capital contributions, and share repurchases are owner transactions, so they are excluded. Foreign currency translation gains, effective cash flow hedge gains, and pension OCI adjustments can all be part of other comprehensive income. The memory line is simple. Non-owner performance is included, owner movements are excluded. If the owner caused it directly, do not force it into comprehensive income. Question 3 asks, which presentation is acceptable for comprehensive income? The options are statement of cash flows only, notes only, retained earnings statement only, or combine or 2 consecutive statements. Think about the permitted formats under ASC 220. The correct answer must present comprehensive income through the proper statement structure, not hide it somewhere it does not belong. The correct answer is D, combined or 2 consecutive statements. ASC 220 permits either a single continuous statement that moves from net income into OCI and then comprehensive income, or 2 separate but consecutive statements. Under the 2-statement approach, the second statement begins with net income and then adds OCI components. Cash flow statement presentation, notes only presentation, or a retained earnings statement alone will not satisfy the requirement. Comprehensive income needs a proper stage, not a hidden corner. Question 4 asks, where is AOCI presented? The options are as revenue, as a separate equity component, inside APIC, or inside retained earnings. Think balance sheet classification. AOCI is not an income statement account and it is not owner contributed capital or accumulated net income. It has its own place in equity. The correct answer is B, separate equity component. Accumulated other comprehensive income is presented within stockholders' equity but separately from retained earnings and additional paid in capital. Retained earnings accumulates net income less dividends. APIC records owner contributions above par. AOCI stores accumulated OCI balances net of tax and net of reclassifications. Think of AOCI as a separate equity locker. If you throw it into retained earnings or APIC, the equity section becomes messy very quickly. Question 5 asks, why are reclassification adjustments needed? The options are to avoid double counting, to remove all OCI, to close revenue accounts, or to calculate gross profit. This is one of the most important ASC 220 questions. Think about an unrealized gain that first appears in OCI and later becomes realized in net income. The correct answer is A, to avoid double counting. If an item is recognized in OCI in one period and later recognized in net income, comprehensive income could count the same economic gain twice unless an adjustment is made. Reclassification removes the prior OCI effect when the amount enters net income. It does not eliminate all OCI, close revenue accounts, or calculate gross profit. The common term is recycling. Accounting likes recycling here, but only for gains and losses, not for wrong answers. Question 6 asks, unusual or infrequent items are reported where? The options are directly in equity, below comprehensive income, only in notes, or continuing operations. Focus on ASC 220-20. These items are income statement items, but they do not create a separate category below the normal performance statement. The correct answer is D, continuing operations. Items that are unusual, infrequent, or both are presented as a separate component within income from continuing operations when applicable. They are not recorded directly in equity, not placed below comprehensive income, and not disclosed only in notes without proper statement presentation. Also remember the exam trap. The per share effect of these items is not separately presented on the face of the income statement. There is no special downstairs room below comprehensive income for these items. Question 7 asks, business interruption proceeds are generally classified based on what? The options are size of proceeds, nature of the loss, tax rate, or entity size. Think about what the insurance payment is replacing. Is it replacing lost margin, fixed charges, extra expenses, or something related to a damaged asset? The correct answer is B, nature of the loss. Under ASC 220-30, the presentation follows the underlying loss being compensated. Proceeds for lost margin follow that economic substance. Proceeds for fixed charges or extra costs follow the nature of those costs. Classification is not driven by amount, tax rate, or entity size. Also remember that proceeds related to replacing an asset should not reduce the cost of rebuilding or replacing that asset. The asset and the recovery should not quietly cancel each other in the corner. Question 8 asks, in interim reporting, entities must present what? The options are every OCI component, full AOCI roll forward only, total comprehensive income, or no comprehensive income. Think about condensed interim reporting. The rules allow less detail, but they do not allow the comprehensive income concept to disappear. The correct answer is C, total comprehensive income. Interim financial statements may use condensed presentation, so they may not need every OCI component in full annual detail, but total comprehensive income must still be presented. A full AOCI roll forward is not the primary interim requirement, and omitting comprehensive income entirely is not acceptable. The shortcut is about reduced detail, not reduced reporting discipline. Interim reporting is shorter, but it is not on vacation. Now we move into short answer practice. These questions build written explanation skill. In exams and professional work, it is not enough to know the correct rule. You must explain it clearly. Use structured points, proper ASC language, and the reason behind the rule. Write your response in clear, separate ideas before comparing it with the model answer. Strong written answers are usually not long speeches. They are precise, organized, and easy for the reader to grade. Short answer question 1 asks you to explain the difference between net income and comprehensive income under ASC 220. Your answer should address what net income includes, what comprehensive income adds, how the two measures relate, and which items are excluded from both. Build your answer around the formula net income plus OCI equals comprehensive income. A strong answer would say this. Net income represents the recognized revenues, expenses, gains and losses that flow through the income statement under US GAAP. Comprehensive income is broader because it equals net income plus other comprehensive income. OCI includes selected items recognized in equity but excluded from net income, such as foreign currency translation, cash flow hedge effects, available for sale debt security gains or losses, and pension OCI. Owner transactions such as dividends and capital contributions are excluded from both. Net income is the earnings story. Comprehensive income is the wider non-owner equity change story. Short answer question 2 asks for the acceptable presentation formats for comprehensive income. Describe both formats clearly and include the sequencing rule for the two-statement approach. Build your answer around two permitted formats, one combined statement or two separate but consecutive statements. A strong answer would identify two acceptable formats. First, a combined statement presents net income components first, reaches net income, then continues into OCI components and ends with total comprehensive income. Second, two separate but consecutive statements may be used. The first statement ends with net income, the second statement immediately follows and begins with net income, then presents OCI and total comprehensive income. The key sequencing rule is that the second statement must start with net income. Do not let the second statement start wherever it feels inspired. ASC 220 gives it a very specific opening line. Short answer question 3 asks you to name 4 common OCI items and briefly describe each one. Try to avoid writing only a bare list. Add one short explanation for each item so the examiner can see that you understand the nature of the gain or loss being reported outside net income. A strong answer could include these 4 items. Foreign currency translation adjustments arise when foreign subsidiary financial statements are translated into the reporting currency. Cash flow hedge gains and losses for the effective portion are deferred in OCI until the hedge transaction affects earnings. Unrealized gains and losses on available for sale debt securities are reported in OCI until realization or required reclassification. Pension and post-retirement OCI items include actuarial gains or losses and prior service cost effects that are recognized outside net income initially. The list matters, but the explanation earns the marks. Short answer question 4 asks you to explain net of tax and gross of tax OCI presentation. Your answer should say how amounts are displayed under each method and where tax effects must be shown. Think through the difference carefully. The measurement result may be the same, but the presentation route is different. A strong answer would say that under the net of tax method, each OCI component is shown after deducting its related tax effect. Under the gross of tax method, each OCI component is shown before tax with a separate aggregate tax effect line. Either approach is acceptable if the tax effects are clearly presented on the face of the statement or disclosed in the notes. The entity must not omit tax effects, and consistency is important. Tax effects are like exam instructions. Ignoring them usually creates avoidable trouble. Short answer question 5 asks, what is AOCI and why is it separate from retained earnings and APIC? This is an equity classification question. Your answer should define AOCI, explain what it accumulates, and then separate it conceptually from both retained earnings and owner contributed capital. A strong answer would define AOCI as the cumulative equity account that stores net after-tax OCI items recognized in current and prior periods, less amounts reclassified into net income. It is separate from retained earnings because retained earnings accumulates net income less dividends, while OCI bypasses net income. It is separate from APIC because APIC comes from owner contributions. AOCI comes from non-owner economic events recognized outside earnings. Keep these accounts separate because equity is not a mixed fruit bowl. Short answer question 6 asks, why ASC 220 requires reclassification adjustments? Explain the problem, the mechanics, and the common term for the process. Use a simple two-period structure. In year 1, an item enters OCI and AOCI. In year 2, it enters net income after realization. A strong answer would say that reclassification adjustments prevent double counting. Some items are first recognized in OCI and accumulated in AOCI, then later recognized in net income when a triggering event occurs, such as a sale or settlement. Without reclassification, the same gain or loss would affect comprehensive income twice. Mechanically, the amount is removed from OCI in the period it enters net income, and AOCI is reduced. This process is commonly called recycling. It is one of the rare times accountants get excited about recycling, and for good reason. Short answer question 7 asks, how unusual or infrequently occurring items are presented under ASC 220-20? Address statement location, disclosure, and the EPS presentation rule. This is a common exam trap, so be precise. Where does the item go and what should not be shown separately on the face? A strong answer would say that unusual or infrequently occurring items are presented as a separate component within income from continuing operations. They are not placed below continuing operations, not treated as discontinued operations, and not placed below total comprehensive income. The entity should disclose the nature and financial effects so users can understand the item. The EPS trap is that a separate per share effect for these items is not required on the face of the income statement. If an option tries to send the item below the line, treat it with suspicion. Short answer question 8 asks how business interruption insurance proceeds are presented under ASC 220-30. Address the classification principle, the judgment involved, and the specific rule for asset rebuild costs. Think about the economic substance of the insurance proceeds rather than the label on the cash receipt. A strong answer would say that business interruption insurance proceeds are presented based on the nature of the underlying loss being compensated. If the proceeds replace lost margin, fixed charges, or extra costs, the presentation should follow that substance. Management must use judgment when one insurance recovery covers several categories of loss. A critical rule is that insurance proceeds should not be netted against the cost of rebuilding or replacing a damaged asset. The asset cost and the insurance recovery should be presented gross. Insurance money does not magically shrink the asset's cost. The accounting needs to show both sides clearly. Let us close the full ASC 220 practice session with 4 memory anchors. Net income plus OCI equals comprehensive income. AOCI stores OCI separately in equity. Reclassification prevents double counting when OCI items later enter net income. Special items require judgment. Unusual or infrequent items stay in continuing operations, and business interruption proceeds follow the nature of the loss. If this practice helped you, please like the video, share it with colleagues, subscribe to Commerce Regiment, and support the channel as we continue building serious US GAAP education.